The Bank of Canada faces a decision that has economists completely divided, and it's going to directly impact your mortgage payments and renewal strategies for rental and investment properties. Unemployment hit 6.9%, while the Bank of Canada's preferred core inflation measures spiked above 3%, yet headline inflation dropped to 1.7%. Manufacturing lost 31,000 positions in April, creating pressure that shows up in mortgage affordability and rent coverage calculation. This creates a scenario where one group of experts predicts cuts, while another warns rates could stay elevated. Your renewal strategy depends on understanding these competing forces and preparing for both outcomes. The challenge is that the economic signals we're getting don't line up the way they should. Let me look at the numbers that are creating this confusion. When you examine the latest economic data, unemployment jumped to 6.9%, which should signal trouble in the economy. But at the same time, GDP growth hit 2.2% annualized in the first quarter, exceeding the Bank of Canada's forecast of 1.8%. These two facts shouldn't happen together, yet here we are. Manufacturing jobs are disappearing across the country due to trade uncertainty. Auto plants in Ontario have reduced their shifts, while steel mills in Hamilton have cut production. Companies are laying off workers because they don't know what trade policies will look like in the coming months. The fear of tariffs and trade wars is causing real businesses to make real cuts that affect real workers and their families. Yet exports are driving economic growth at the same time. Canadian companies are shipping more goods to international markets than expected. Energy exports hit record levels. Agricultural products found new buyers overseas. Resource companies reported stronger than expected quarterly results. The same trade uncertainty that's killing manufacturing jobs is somehow creating export opportunities that boost GDP numbers. The inflation picture makes even less sense. Statistics Canada reported headline inflation dropped to 1.7% in April, which is below the Bank of Canada's 2% target, while core inflation measures climbed above 3%. This split creates a policy dilemma because core inflation measures the underlying price pressures in the economy that central bankers worry about most. These contradictory signals are making the Bank of Canada's job nearly impossible. Central banks use economic data to guide their interest rate decisions. When unemployment rises, they typically cut rates to stimulate job creation. When GDP grows strongly, they might raise rates to prevent overheating. When inflation runs below target, they cut rates. When core inflation runs above target, they hold or raise rates. But what do you do when all these signals point in different directions at the same time? Economists are interpreting the same data in completely different ways. Some look at the 6.9% unemployment rate and say the Bank of Canada needs to cut rates immediately to support job creation. Others look at the GDP growth and core inflation numbers and argue that rate cuts would overheat an economy that's already growing faster than expected. Still others focus on the export growth and suggest the economy is strong enough to handle current interest rates. This mixed data creates what experts call a high bar for rate cuts. The Bank of Canada wants to see clear, consistent signals before making major policy changes. When half the data says cut rates and half says hold steady, they choose caution. They need overwhelming evidence that rate cuts are necessary before they act. Mixed signals don't provide that overwhelming evidence. The trade uncertainty adds another layer of complexity. If trade tensions resolve quickly, the manufacturing job losses could reverse and GDP growth could accelerate even more. If trade tensions worsen, the export boom could end and unemployment could rise further. The Bank of Canada is trying to set policy for an economy where the fundamentals could change dramatically based on political decisions made in other countries. Which signal matters more for your mortgage? Weak jobs or sticky prices? The answer depends on how economists are reading this data, and their predictions might surprise you. Even though June looks like a no-go for rate cuts, there's a hidden reason why your mortgage payments could still drop this year. The Bank of Canada might hold rates steady next month, but economists see a different picture forming for the rest of 2025. Here's the paradox that's confusing everyone. Most economists expect the Bank of Canada to hold rates in June, but around 75% of those same economists predict at least 2 cuts before the year ends. A Reuters poll shows that 17 out of 23 economists believe we'll get at least 2 more rate cuts in 2025. 7 economists think we'll see 3 cuts. Two economists predict 4 cuts. That's a lot of rate relief coming, even though June looks like a hold. Avery Schenfeld, chief economist at CIBC, explains the bank's position perfectly. He says a cut would be the right step, but the Bank of Canada won't deliver one just yet. Schenfeld points out that the bank has signaled it's less willing to be forward-looking amidst considerable uncertainty over the outlook. This captures the tension between what the economy might need and what the central bank feels comfortable doing right now. The bank's reluctance stems directly from trade uncertainty. Central banks usually make decisions based on where they think the economy is heading. But when trade wars can change everything overnight, predicting the future becomes nearly impossible. The bank prefers to wait for clearer signals rather than guess wrong about trade outcomes. The 225 basis points already cut since June 2024 creates serious pressure to pause so the bank can assess their full impact. That's massive monetary easing in less than a year, and mortgage holders are already feeling relief from previous cuts. David Rosenberg from Rosenberg Research takes the opposite view, arguing that rising unemployment shows the need for cuts now. He points to weak labor data and suggests the Canadian economy has entered a recession. This contrasts sharply with the majority view that counsels patience, highlighting how divided experts remain on timing. The Bank of Canada is considering 2 distinct scenarios from their April monetary policy report that will shape their decisions. In the first, most of the new tariffs get smoothed out through negotiations, keeping their impact relatively small, though the uncertainty would still linger. The second scenario paints a much tougher picture, a prolonged global trade war with hefty, permanent tariffs that could hit Canada hard, even causing a year-long recession. It's worth noting these are just examples of what could happen, not actual predictions. Douglas Porter from BMO Capital Markets explains why the bank feels torn. He notes there's caution from the core inflation numbers, since core inflation sits at the high end of the bank's target range. But there's no urgency from the growth numbers, because GDP growth has exceeded expectations. This mixed picture makes it hard to justify immediate rate cuts. The bank plans to keep the door open for future rate relief even if they hold in June. They want to maintain flexibility to respond as economic conditions change. The July monetary policy report should provide a firmer growth forecast that could influence future decisions. The reason cuts are still coming despite the hold comes down to economic fundamentals. Unemployment at 6.9% suggests the labor market needs support. Manufacturing job losses continue due to trade fears. Even with strong GDP growth, the underlying economy shows stress in key areas. The bank recognizes these problems but wants more certainty before acting. Rate cuts later this year remain likely because the economic data will eventually point in one clear direction. Either trade tensions will resolve and growth will need support, or trade wars will worsen and the economy will need stimulus. Both scenarios suggest lower rates ahead, which means you need to prepare for multiple outcomes when planning your renewal strategy. The mixed signals from the Bank of Canada create 2 distinct paths you need to prepare for right now. Start running the numbers on both outcomes before your renewal comes up. Use a mortgage calculator to figure out what your payments would be at current rates versus rates that are 1 or 2% lower. Know exactly how each scenario affects your cash flow and investment strategy. Both scenarios remain plausible because the Bank of Canada faces contradictory economic signals that make their decision nearly impossible to predict. Understanding these dynamics puts you ahead of the curve and reinforces confidence in long-term real estate investing despite rate uncertainty. If you like this kind of content, be sure to watch my next video on whether or not you should invest in mortgages that can earn you double-digit returns.